Madam Secretary, please call the roll.
Senator Boswell. Here. Senator Deneen. Here. Senator Douglas.
Present.
Senator Funky Fromeyer. Senator Givens. Senator Mays Bledsoe. Senator Neal. Senator Nemus.
Present.
Senator Webb. Representative Banta.
Present.
Representative Bentley. Representative Bowling. Representative Bray.
Present.
Representative Brown.
Here.
Representative Dietz.
Present.
Representative Dossett. Representative Flannery. Representative Fleming. Representative Fraser Gordon.
Yes.
Representative Freeland.
Present.
Representative Fugate.
Here.
Representative Gentry. Representative Hart.
Here.
Representative Johnson.
Present.
Representative McCool.
Here.
Representative McPherson.
Here.
Representative Colombo.
Here.
Representative Raymond. Representative Riley. Representative Stevenson. Representative Upchurch. Co-Chair McDaniel.
Here.
Co-Chair Petrie.
Here.
All right, very well. I'd like to thank everybody again for being here. We're duly constituted to conduct business. First of all, I'd like to welcome Heather Hamilton to our staff today. First time up with us, so we appreciate you having you on board. All right, with that, we'll go ahead and start taking a look at the pass-through entity tax. If DOR and Office of State Budget Director would like to come on up and kick us off here today. And we do have one introduction before we get rolling here. Co-Chair Petrie.
Thank you, Chairman McDaniel. I have with me today a very special guest in the very back of the room. My wife of close to 30 years coming on this next year, Denise Petrie, is with us today, and I really appreciate her coming up with me this week. Thank you.
So do I need to make the official nomination for sainthood, or will somebody from the House handle that? Yeah. Very well. All right. Guys, if you'd like to proceed.
By way of introduction, my name is Greg Harkenrider. I'm with the Office of State Budget Director.
Good afternoon. My name is Barbara Quackenboss. I am the Executive Director for the Office of Income Taxation at the Department of Revenue.
Good afternoon. My name is Bethany Rice. I'm counsel for the Department of Revenue, Executive Director of the Office of Legal Services for Revenue.
Liz, can I ask you to pull your microphone just a little bit closer when you talk, please? Thank you very much. Go ahead.
Well, I will start today. We have some questions that were posed to us, and I would like to...
We're very sorry. Could you please pull that mic just a little bit closer?
Oh, sure.
And
Of
maybe
course.
point it towards it's kind of directional.
Sorry about that.
That's better.
Okay, so I would like to go over and just do a brief overview of the pass-through entity tax for everyone today with the passage of House Bill 5 in the 2023 General Assembly. Prior to the passing of House Bill 5, pass-through entities, which are entities that are partnerships, limited partnerships, and some S corporations, would have their income passed through to their individual returns, and they would be taxed at the individual return. So the entity itself would not pay any income tax themselves. Under both the federal and the Kentucky law, that's how it was prior to House Bill 5. In 2017, when the Federal Tax Cuts and Jobs Act came about, there was a cap on the itemized deductions that were able to be taken on a Schedule A individual return, and the cap was $10,000 for married filing joint and $5,000 for those that were single filers. And what that means is the state and local taxes that they would be able to deduct on a Schedule A were limited to $10,000. And in some instances, taxpayers might have in excess of that, and they would not benefit from taking that deduction if they had a pass-through entity. So effective through 2025, this Tax Cut and Jobs Act is in effect. Similar to other states, in 23, the General Assembly passed the pass-through entity tax for Kentucky, and it was retroactive to 2022, even though we were in a 23 tax year already. And this allowed for the entity itself to make an election and pay tax on the individual income tax rate at the entity level and pass a credit through to the individuals or the other partners to be claimed on the individual return. And it was 100% refundable credit. So even though the entity paid the tax and the taxpayer claimed the income on their individual return, they were not being double taxed because there was a credit afforded to them that would make them whole. We refer to this as the SALT workaround for state and local tax. And the IRS also issued some guidance on this that allowed for pass-through entities to take the deduction on the business return, meaning those pass-through entities could take that deduction on the federal level and take down the ordinary income by claiming that expense. So what that means is the entity could take any tax that they paid to the state of Kentucky and deduct that on the federal return. And it would reduce their income that would flow from the pass-through entity at the federal level to their individual return, and that would put them in maybe in a lower tax bracket, or if you've ever seen the IRS grids, it's always broken up by hundreds, and it would have them pay a little bit less tax. The pass-through entity election was allowed for January 1, 2022, and so for us it was retroactive. We did have to implement it fairly fast at the Department of Revenue, but we were able to get that done in 2 to 3 months. And the pass-through entity election is scheduled to sunset in 2025 for the federal, but that's basically an overview on how it works. Thank you.
For a discussion of the data itself and the forecasted values and the actual values, I'm going to run through some slides with you real quick. Barbara already talked about the pass-through entity tax, the entity part, which I'm going to call payments. She already talked about that. She also talked about the dollar-for-dollar refundable tax credit that goes with them. I'm going to make a point in my talk to talk about the fact that the payments are very conspicuous if you follow the receipts reports. It's aligned right on the receipts report, right on the front, and we follow it monthly. The credits are a little bit tougher to meet out of the data. The credits are against the pass-through entity tax was new, so of course we followed it as a new tax. The credit side is not really a new data series for us because we already had data on the 3 uses of the credit. They can claim the credit with lower individual estimated payments. They can claim it by lowering withholding, especially the requirement for non-resident withholding for non-resident partners. And then they could also claim the credit when they file their 740. So none of those data sources is directly observable in the receipts data. So, when you see the pass-through entity tax data on the receipts report, it's not net, it's the gross payments, and it doesn't take into account the credits. So the CFG met in 2023, September and December, like we normally do for a budget session. And we projected payments for 24, 25, 26. I will say that all my years with the CFG, this is one of the more difficult things to predict. Lots of reasons for that. One is that it just passed in the 2023 session. We didn't have a lot of time to understand it. It's also an elective tax, as Barbara said. You have to opt into paying the entity level tax. So we had to sort of figure out the take-up rate. Since it was elective, we didn't think everybody would choose to be taxed as an entity. The retroactivity also made it difficult to forecast the payments because we didn't know the timing at which the 2022 returns would either come in or payments would flow in for the 2022. So that made it a little bit more difficult to forecast. But the long and the short of it is we only had 4 months of PTET data when we did the forecast, and we do quarterly models, so that was 1 quarter and 1 month of data, and we had to forecast, as I said, the 3 years. So it was a challenge. One thing we did know is for members and shareholders to achieve maximum federal benefit, we knew there were deadlines, and we thought at the time when we did it that the deadlines being in the first half of the fiscal year, that we thought most of the payments would come in early in the fiscal year. So the estimate we came up with, given the history that we had, was $315.4 million for estimated payments in fiscal 24, and I've got the breakout of the quarters: 187.4, 113, and then as I said, we thought most of the money would come in the first 2 quarters. So we had 0 forecasted for the third quarter, and $15 million for the fourth quarter. So we also that was on the payment side, and I told you we're interested in the net, so we had to figure out when the credits associated with those payments would hit, and we thought that it would be an 80-20 split. 80% of the money that came in fiscal 24 we thought would go out as a credit in 24, and 20% would be sort of moved to fiscal 25. So our official forecast for 24 was 50, and again, we're forecasting the net payments. That's all the CFG cared about, because really, we're just looking for a simple deduct to do for this whole pass-through entity thing, away from our normal course of forecasting the individual income tax. So we came up with 52.7 to the good in 24 because we're pushing some of the credits to 25. And then we had the forecast was negative 71.9 for 25. As you can see, the credits outweighed the payments, largely because you're paying some of the 24 credits in 25. That was the assumption. And 26 was sort of a long-term. We thought that this would be revenue neutral in the long run, that the payments in and the credits out would be roughly revenue neutral. So 26 is sort of a steady state estimate of roughly revenue neutral on the net side. So how did it come in? The payment forecast, how did it come in? Well, you can see the estimate, the 315.4 that I just talked about. The actuals came in at 791.9. I'm sure, Mr. Chairman, when you were following the monthly receipts, that you noticed, man, this thing is creeping up there. We ended the year at 791.9. The more surprising than the total amount was the fact that we got, if you add up the 186.1 in the third quarter and the 225 in the fourth quarter, we got $400 million in the second half of the year, and that was we didn't expect that. Let's just say, and so the difference between actual and estimated was $476.5 million. Does that mean we missed the forecast by $476.5 million? No, because we're forecasting the net, not the gross payments. So clearly, the volume and timing was not correctly picked by the CFG and us as staff presenting to them, but actual taxpayer behavior differed substantially from our expectations. To get the net number, you have to quantify the credits, and the credits are very difficult to quantify. As I said, they were existing aspects of the individual income tax. There were offsets to the net returns, offsets to the declaration payments, offsets to non-resident withholding. So one part that was kind of measurable is the net returns part, because for 2023 returns, they're able to pull from the Form 740. If you go to line 31G, it says enter your 2023 refundable pass-through entity tax credit from Form whatever, PTETCR. That information can be captured. We captured it, but it only tells part of the story, because what shows up on a receipts report is net returns, not net returns associated with the pass-through entity tax. So it's commingled with normal net returns data. So we can't really use our global data to judge how much credit was used. Same with declarations and non-resident withholding. We follow those, but we don't follow the part of it attributable to the pass-through entity tax. So we don't know exactly what the credit side was. And let me show you just real quickly on the line 740, the 31G, the line 31G. If you think of a 740 and most of the way down on the second page of 3, you'll see line 31 and 31G. That's where they enter that, and that's where that data is coded by the Department of Revenue, and we can pick that up. So it's not enough to just say we don't know what credits were. We have to do analysis going forward. We have to constantly update our projections of what we think the net amount that we're trying to get at came in at. So one hypothetical way that you can estimate credits is to make an assumption that 2023 and 2024, when you compare the two, if you assume that they're all else equal between the 2 years except for the rate change, we took out the effect of the rate change. So we adjusted 23 down to equalize it at the 4%. This is just a really rough estimate of what the effect of the net returns reduction. We know the sign on net returns, it's got to be heavily weighted to the negative. We know declaration payments can only go down because of this, and we know non-resident withholding can only go down. So we, as our rough guess of what those would be, we have 281.9 attributable to net returns, 115.6 attributable to declaration payments, and another 109 million to non-resident withholding. So those are the three things that we would hypothetically deduct from the 791 to get to the net amount. So it would be incorrect, I guess, the way I'll leave it before I hand it back is, it'd be incorrect to look at the 791 and our forecasted value for the 791 and assume that's going to hit, the difference between those two is going to hit in fiscal 25, because we don't believe that to be the case due to these unmeasurable credits that have already been taken that just don't show up in the data. So with that, I'm going to turn it back to Revenue to answer some more of the questions that you asked.
Thank you. So one of the other items that was asked for was a brief statement about the retroactive nature of the new election and what documents were required for those periods versus what will be filed for ongoing basis on going forward. The Department of Revenue, when we established the forms for the pass-through entity, we made a form that was very similar to our non-resident withholding form to follow along for the taxpayers and the preparers. We did have an election box on the actual return itself the first year because it was retroactive, so we felt that if they want to make the election, they could make the election and file the return on the same document. We quickly found out that taxpayers in the subsequent year would like to make an election separately during the year before they actually filed the return. So we did create a 2023 and 2024 election form to be filed separately. It wouldn't require them to make a payment. It would just let them check the box saying that the entity was going to pay the tax. And also with this retroactive initiative, we did not prepare for estimated payments to be paid because KRS 141-209 said that the estimated payments were not required until January 1, 2024. However, we quickly found out that taxpayers wished to make the payment so that they could take these benefits on their federal return. So we quickly stood up a online portal for the taxpayers to make the payments online. Also with this, the team is going to continue to use the same tax return that we created initially going forward for this pass-through entity tax. For 2023 and 2024, unless there are legislative changes, we plan to keep the form exactly the same. The other question was the administrative timing of processing the current returns received, comparing pay returns versus refund returns related to election, and the volumes of returns received for each category. Unfortunately, because this is very new, we do not have a detailed breakout of pay versus non-pay. What we do know is during this current year on the individual tax returns that we are processing, at the end of the fiscal year, June 30th, we had 1,096 individual tax returns left to process that had a claim for a PTET CR credit. So we're very on schedule with the refunds that we are issuing related to the individual tax returns. I do also know that between the April and June, at the end of the fiscal year, we did have approximately 20,000 returns that claimed a PTET CR credit. It has been challenging for us because the entities have an extended time to pay the actual pass-through entity tax per the legislation, and they really had until August 31st, 2024, which is just now coming up, to make the election and pay the pass-through entity tax, whereas the individual returns were already being filed and taxpayers were already claiming these credits. In addition, the pass-through entities which report and pay tax on behalf of their non-resident members requested refunds from the non-resident returns. So what that means is during 2022, the non-resident partners were making estimated payments toward their non-resident returns. And when this legislation passed, they wished to get those estimated payments back to use for the pass-through entity tax. So that caused quite a bit of monies being moved around from one tax to the next tax and being refunded and paid back into the Department of Revenue. So the retroactive perspective of this was, a lot of moving parts and a lot of money being shuffled from one receipt account to another. But the influx of these requests for refunds shortly after the 141-209 passed caused a little bit of a processing backlog for the Department of Revenue, but we managed very well with the staffing that we did have.
Good deal. Thank you, guys. One quick question,
Yes, sir.
Greg, I think is more of a forecasting issue. With the fact that these are refundable and their credits and our income tax rate is a fixed number, there's really no incentive to defer those credits until a year where you may have a higher income, because it gets equal treatment regardless, right? In fact, if you want to take inflation into account, you might be better served to exercise them sooner.
Yeah, being refundable, there's no real downside to taking it. Now, we have seen some activity where somebody had the ability to claim a refund, but they took a credit forward and they decided we're not going to take the refund necessarily. We're going to apply apply what we would have got back to a future tax period, presumably to lower their declarations or something. But there are some credit forwards that do occur. But in terms of the economics of that, I don't really understand why somebody would do that. But it has been something that we've noticed, people using credit forwards. Barbara, is that accurate?
Yes, we do have taxpayers who request to move their overpayment to the next period, which would automatically become an estimated payment for the first quarter.
Got it. All right. Other questions? All right. Thank you guys very much. We appreciate it. All right. Next up, I think we got
Thank
the
you.
Chamber of Commerce to talk about the same issue. All right, gentlemen, welcome. If you'd identify yourself for the record and proceed, please.
Charles All, Executive Director of the Kentucky Chamber Center for Policy and Research.
Kevin Huey, partner with the accounting firm of Cherry Beckert, formerly MCM, so many people don't know who Cherry Beckert is.
Kevin, would you pull your microphone a little bit closer and make sure your green light's on, please?
Yes.
All right, thank you, guys.
Well, thank you all for having us. We appreciate the opportunity to come speak on this issue. Some of what we say may be redundant. However, given the complexity of this tax, I think some of that redundancy may be welcome as we reiterate some of the things we already said to help you all get a full understanding of how this tax works and why we think that it is also beneficial. So I'm going to give some high-level marks to talk a little bit about the competitiveness side of this, the economic side of this. And then Kevin will give the perspective as a practitioner who's actually worked with some of these returns. It can really get into some of the details of how this tax works and how it works for pass-through entities and those types of businesses. A couple things to mention. This legislation was passed in 2023. It was the product of House Bill 5 and also House Bill 360. Thank you to Chairman McDaniel, Chairman Petrie for their work on this, as well as staff. I also want to mention Representative Ken Fleming, a member of this committee, also had legislation that he filed early in the 2023 session. So a lot of thought went into this. We also partnered very closely with KYCPAs in helping to work on this legislation and to advocate for it as well. So it was a good partnership. I think the simplest way to understand this pass-through entity tax, and I'll just highlight, this is a new tax. And it's an example of where the business community actually suggested the existence of this tax, which I think highlights some of the complexity of it, but there's good reason for why the business community was saying this would actually be a good tax to create. And the reason for it is that it's a voluntary tax option for business owners that allows them to reduce their federal income tax liability. It also supports parity between the federal tax treatment of corporate businesses and non-corporate business owners. And so that's another really important component of this. But I really want to emphasize the intent of this is to help reduce federal income tax liability. In terms of the state side, as Kevin will highlight here in a minute, the intent would be there's no difference on the state side. For the state ultimately in the long run to collect the same as they previously were. The difference and the benefit is realized on the federal side when that taxpayer files their federal return. Finally, just mentioning this is an approved practice by the Internal Revenue Service, and Kevin can talk a little more about how that played out. I think one of the most important things to keep in mind, though, as we talk through this tax is this map that we have right here. And this is something that I took from the American Institute of CPAs. And what you can see here are states that have this tax, states that don't have this tax. Of the 40 jurisdictions that levy a personal income tax, or I should say of the 41 that do, 36 of them have a pass-through entity tax on the books. These other states that do not are highlighted in gray. These are states that do not levy a personal income tax, so most notably Tennessee to our south. They have less need for a pass-through entity tax because the benefit would be more difficult to realize because they do not have that personal income tax. Pennsylvania, at the time that this map was created, was considering legislation on this. For any of you that follow sort of state tax policy, Pennsylvania does tend to be a little bit slower to adopt a lot of policy, especially when it comes to tax. But beyond that, there's just a small handful of states that have not done this: Delaware, Maine, North Dakota, and then the jurisdiction of Washington, D.C. Those are the only entities. And so I think that's really important to keep in mind as we think about this tax, and to imagine Kentucky being listed on here as a state that wouldn't have this. Think about the competitiveness impact that would have on our state from the perspective of owners who can benefit from this, when the next state just over, the next state to the west, to the east, to the north would have these benefits. So this is an important part of our broader economic competitiveness landscape. With that, I'm going to turn things over to Kevin to talk a little more about the details of this thing.
Some of this is redundant from what was spoken earlier. First of all, I'd like to tell you, this is good law. You did a great job in passing it. I know you probably don't hear a lot of those sometimes, but this is good law. And the Department of Revenue did a great job implementing it. They were under the gun, just like the practitioners were under the gun to understand the law, and they did a good job of getting it passed and compliance. So it's in good shape. Again, it was created by the Tax Act of 2018, where your local and state tax deductions were limited to $10,000. One thing to keep in mind, the $10,000 also includes property tax. So it's all your taxes. So there's a cap at $10,000. You got the low cap. They increased the standard deduction. So what ended up happening is individuals did not get to deduct their state taxes. So states began the workarounds, and the IRS approved it with Notice 20-2075. So, this is good law, and I'll just show you a simple example. Now, it gets more complicated than this, but I put together a simple example that you can kind of follow. The pre-PTET law, where a resident makes $100,000, okay, and we're using a tax rate of 4%, they pay $4,000. Just like they filed their tax return, and they wrote a check for $4,000, or they had withholding, paid $4,000. Post PTET, what happens? They're still making $100,000. The business is making $100,000. The business pays the $4,000 in. The individual takes a credit. You can look at it just like withholding on their individual return for Kentucky. So you're in the same spot. The difference is they get to deduct that $4,000 at the federal level. So their benefit, I guesstimated it at $800 on a federal tax benefit. So both scenarios, Kentucky received $4,000. Now, the discussion that happened a little earlier, the issue is the timing could be different. I mean, the timing and payments were much different than standard. We had to August 2024 to pay some of 2022 tax. So cash flow wise, I can see a difference. However, total in cash receipts over a period of time should be the same. It shouldn't be different. It should work out. So very favorable tax law for the state of Kentucky and the residents and businesses.
I'll highlight just a few other remarks that we have heard from chamber members that could be helpful. A lot of it really echoes what we just heard from Kevin. Again, highlighting the economic competitiveness, since this tax benefit is available in all surrounding states and even beyond to other states that are around Kentucky. There are some similarities between the way that Kentucky's law was written and particularly Indiana's. There's also some similarities with Ohio. So when you think about multi-state tax filers, this is something that does help simplify that process. There is a good degree of flexibility within this law, which again, I think accounts for different types of businesses, different types of deeds, and the fully refundable credit structure. That is a good thing. That is arguably the simplest way to do this. Other states structure things differently. Some states have non-refundable credits. I think very, very few. Some may have changed that actually.
Very few.
Very few use non-refundable credits, but there are other structures. But this was determined, especially by the CPA community, to be by far the simplest way of handling that issue of avoiding double taxation, which is, of course, something we'd want to avoid. Of course, as our friends at OSBD and the Department of Revenue highlighted, this is a complicated tax, and I think that has been underscored throughout both presentations today. As questions come up, as there's need for guidance and clarification, we simply would just support a collaborative approach to that, where practitioners and the Department of Revenue are able to work together to sort through any issues that might come up throughout the course of implementing this tax. Couple things that do need to be highlighted here, though, in terms of the future of the pass-through entity tax and the SALT cap. The $10,000 SALT cap expires at the end of 2025, along with most of the Tax Cuts and Jobs Act. Big question now is, will that cap be extended? So will we see a continuation of the $10,000 cap? Might that cap be tweaked? There was a proposal as part of a federal or congressional tax package a couple of years ago. This suggested maybe an $80,000 cap, $50,000 cap. There's even been some conversations of reducing it, eliminating it altogether, also reforming it. There are some structural components with the SALT cap that are under consideration. Beyond that, might Congress address state-level pass-through entity taxes? So far, Congress has not opined on this issue whatsoever. Department of Revenue or the Internal Revenue Service has allowed for these, but again, Congress has not directly weighed in. With that in mind, we still don't really know what the next administration might weigh in when in terms of state pass-through entity taxes. So there are some unknowns, at least through 2025. And so that's something we'll be watching for, and I think we'll be communicating with members of this body to keep you updated on how that progresses. So with that, I think we're happy to take any questions.
Sure. So one brief one. If it's a simple expiration at the federal level, there's really no need for us to do anything. This will still remain on there as a tool. It'd just be something that would be irrelevant to try to use because you have your federal deduction back at that point.
Well, that could be a little more complicated. I would argue that the PTE deduction would be advantageous even if the cap expires, because it moves it off as an itemized deduction and moves it over as a deduction on the business return.
It'd be advantageous to the corporation, but to the individual, there still would be.
If it flows through to the individual, for instance, it's a flow-through entity. Mm-hmm. When I say that is, income from the entity flows to my personal return, okay? So I get the deduction at the entity level. It comes to me with the deduction already taken. Mm-hmm. So therefore, I'm not subject to limitations on my individual return, which I could be. And for instance, a lower income individual may be taking the standard deduction on their federal return now, okay? So they still would get the deduction plus the standard deduction, so they would get advantage as well. Does that make sense?
Yeah. Okay. Senator Boswell.
Thank you, Mr. Chairman. So as we go into the future, it's our plan to eliminate the state tax altogether. In the example you gave, there wouldn't be a $4,000. So does this become less of an issue as we go in the future if the state income tax is completely eliminated?
Yes, would. I mean, unless somebody's operating in another state, but yeah, it should be eliminated if you're doing away with the state income tax. I can't think of a reason why you would have.
Thank you.
I would applaud you doing away with the state income tax too.
All right. Any others? All right, seeing none. Gentlemen, thank you again for your time. We do appreciate it today.
Thank you all.
Not. Right. Yeah. Okay. Next up, tax increment financing and individual income tax rate reduction. Brett, come on up. Identify yourself for the record, please. Brett, would you turn your microphone on, please? May pull it a little closer then. It's not hard.
Is that better?
Oh, much. Thank you.
Okay. Technology challenged here. My name is Brett Antle. I'm a partner at Commonwealth Economics in Lexington, and I've been asked to speak here today on the impact that rate reductions to the personal income tax rate will have on, or can have on, tax increment financing districts around the state. And would like to kind of start with looking at some background on this, kind of how this came about. During the 22 regular session, the General Assembly passed the tax reform bill, House Bill 8. And of course, one of the things that was implemented at that time was this two-tiered formulaic model to reduce the state's individual income tax rate by 0.5% at a time, for each year that it passes both of the two-tiered tests. The general fund met both of these tests for the first 2 fiscal years that were tested, which were FY21 and 22, and this resulted, of course, in the individual income tax rate being reduced from 5% to 4.5% for 2023, and then another reduction to 4% for calendar tax year 2024. One of the things that happened is I would just call it an unintended consequence of the rate reductions was the negative impact that these reductions could have and would have had on our tax increment financing districts that were already in existence around the state. And so just want to kind of walk through this if you allow me here. Prior to 2023, for each calendar year that a TIF district had its increment calculated, this was the simple formula for each of the tax types that arrived at how much of each tax would be rebated. So taking the IIT as our example here, you start with what's referred to in statute as new revenues. This is simply the gross tax receipts within the TIF footprint, the physical footprint of the TIF, less old revenues, which is commonly referred to as the baseline, and that's a number that also gets inflated by CPI annually each year. But that is the amount of tax revenue that was being generated within that footprint prior to the TIF district being approved. And so you subtract the first from the second, you get an incremental tax amount that is being generated each year, and then each TIF participates at a certain percentage of that back to the applicant recipient. In most cases, it's 80% or less, and then the result of that calculation is a rebate to the local government entity that is the applicant. As an example here of how this rate reduction can have an impact, if we look at a hypothetical tax increment financing district with, let's say, $1 million of taxable income, taxable wages, and a baseline of 0, just to keep it simple for the time being, and comparing that, what you'll see is on the left hand here is a chart that would show kind of how that formula would work out and what would be rebated were there to be $1 million of net taxable wages in our hypothetical TIF here and an IIT rate of 5%. You would have new revenues calculated at $50,000, assuming no baseline. That would be your increment, and then an 80% participation rate would get you to a rebate of $40,000 is actually how much would come back to the local government in that situation. If you reduce the IIT rate by 0.5% to 4.5%, the new revenue number now is $45,000. So you've got the 10% decrease, and that's also your increment. You multiply that times an 80% participation rate, and of course now your rebated increment is now only $36,000 in our example. That is a 10% reduction. You've reduced the rate by 10%, and the rebate turns out to be 10% lower. That's if there's no baseline. But if there is a tax baseline in the TIF, that has been approved. In other words, it was already generating some amount of state taxes before it was ever created, before the district was ever created there. The impact on a percentage basis actually increases the higher that the baseline that you started with was. As an example here, you can see that you walk through the same steps again with a hypothetical baseline of $10,000, and in this case, our rebated amount on the left-hand side is $32,000. Excuse me. And on the right side, it's $28,000. Now, the absolute dollar reduction of the decrease in the rebated increment is still only $4,000, just like if there were no baseline. But on a percentage basis, the impact is actually higher. As you'll see, $4,000 as a percentage of $32,000 is now a 13% impact from that tax change. And just to kind of keep with the same example, if we raise the baseline amount, let's say instead of $10,000 it was $20,000, you'll see that the bottom line reduction now becomes a 17% rate reduction in the amount of the rebated increment. So, but do excuse me, I want to get a bottle of water in my mouth. Sorry about that. So in 2022, after the tax law had been changed, in consultation with a number of our clients who are local governments and otherwise that are recipients of state TIF dollars, our firm Commonwealth Economics, we looked at a lot of variations to this basic formula that we pointed out earlier. We looked at things like adjusting the baseline down by a certain amount. We looked at increasing the state's participation rate. We looked at extending the term of these TIFs, and really the result in all of that modeling was that none of those or any combination of those was going to be able to produce a viable or acceptable solution to both the local government and state government. And what we needed to do is kind of think a little bit out of the box and come up with an alternative strategy. And so what we did was, again, in consultation with our clients, we developed what we think is a pretty simple strategy that fully mitigates the negative impacts of these rate reductions. And this strategy involved a simple adjustment to the definition of new revenues at the top of that increment calculation, and it leaves the rest of the formula and the rest of the entire process the very same. Nothing else changes about the process. It's only an additional step in the formula when the Department of Revenue actually does the end calculation. So beginning with calendar year 2023, there would be an adjustment to new revenues as part of the IIT increment calculation process. And I don't know if I failed to mention this or not. No, I'll keep going. After the revenues the new revenues have been calculated by the Department of Revenue in each one of these footprints, the amount of that gross revenue would then be multiplied times what we termed a multiplier, which is simply equal to 5%, the former flat tax rate, divided by the tax rate in the year that the calculation is being performed in. So for 2023, very simply, that multiplier was 5% divided by 4.5%. times the otherwise new revenue amount. That I think that modifier is about 1.11. And the result of that gets you a what we call modified new revenue amount to replace that new revenue number in the formula that actually is still the equivalent were the rate still at the 5% that it was prior to 2023. And this modified new revenue amount would take the place of new revenues in that increment calculation formula. And just to give you an example here, so under this strategy, the increment calculation formula for IIT is now modified by replacing new revenues with modified revenues, just as we've explained there. And everything else about the formula remains the same. You still subtract the baseline. The baseline amount is still inflated each year based on CPI. Nothing else really changes about the calculation. To give you a look at kind of how this will work over time with a declining income tax rate, as you'll see, we still go back to our example here where you have a hypothetical TIF with $1 million of net taxable wages, and what that ends up generating in rebated increment when you apply this modifier to it, which is the fourth line down. You can see from 1% to 1.11 to 1.25. As the tax rate declines, the modifier goes up, and it normalizes the amount of revenues such that the rebated amount is still the same as if the tax rate were at 5%. And the reason that this was so critical was that there are several no two state TIFs are the same, but there were several state TIFs that heavily relied on the individual income tax as the primary tax generator. So without taking some type of action, if we got to a point where the rate actually, the IIT rate got down to maybe 3.5% or 3%, the TIF would be done because it was so dependent on it. It would no longer be able to actually generate more new revenues than the baseline would allow. So what happened was, as we talked with some of you going in before the 2023 session about this, and the General Assembly adopted legislation during 2023 under House Bill 360, which in fact implemented this new modified new revenue approach for calculating the IIT increments. However, under House Bill 360, this was only adopted for a 2-year period, for calendar tax years 2023 and for 2024. And then in this year's regular session, the General Assembly also, under House Bill 8, this current year, extended the adoption period for this modified new revenue approach for another 2 years through 2026. To give you an example of why this is needed and the impact that it has, I'm showing you here, we don't have any of the calculations done for 2023 yet. We're still waiting on those, but taking the actual IIT calculations that were done for 2022 for 10 of the TIF districts that we have access to the information, and plugging those in, you can see that our total revenue for those 10 districts was new revenue was a little under 17 million, and we had a baseline for those TIFs of totaled about 9.9 million. This is in summary for all 10 of these. So we had an increment of about 7 million, between 7 and 7.1 million, and there were a total rebated increment. There were total rebated increments for the individual income tax of over 5.6 million to these 10 TIF districts. if we held everything else the same, the amount of taxable wages, and we kept the baseline the same, all other variables being the same, and we simply modified the tax rate from 5% down to 4.5%, that 10% reduction in new revenues, you can see as you walk through the formula, the rebated increment would only be just under $4.3 million. So that's a reduction of $1.35 million that would otherwise have been would otherwise be rebated to these local governments, and on a percentage basis, and this is an eye-catching number to me, that's a 24% reduction in the amount of IIT rebates. And so, in particular for the TIFs where they are heavily weighted and depend the most on the individual income tax, this is a significant and almost impossible to overcome reduction, because as with all TIFs, there is debt that has been issued behind these projects. None of these projects get funded all with cash, and in many cases it's the local government issuing general obligation bonds, or they have acted as a conduit issuer on behalf of a private party for some of the infrastructure related debt. And in any case, they are dependent upon these rebates coming in to repay part of the debt that has been incurred for the project. And without this modifier in place, these are significant reductions in the amount of that IIT increment that would come back to them, and it's needless to say would have a material impact on their overall ability to actually repay the debt service or repay any loans that have been taken out. So just to kind of end up here, we have some discussion points at the end of this. Since the modified revenue language has only been authorized at this point through 2026, there remains a significant risk to our existing TIF districts that were approved prior to 2023 of further rate reductions that would come after the 2026 year when the current law would sunset. Also, we also have the issue here with where if that rate, if the IIT would ever drop to zero, as it's been mentioned, the intent is to go all the way to zero. At whatever point that is, there would need to be an alternative approach to this developed at that time. If we take the income tax rate all the way to zero, we can no longer calculate the modifier. So that's something that would have to be looked at that point in time. And then finally, and this is also important, I think for the Economic Development Cabinet, where TIF has been one of their key economic development programs. It's a program that brings large projects and large economic development projects to the state. And as the law right now is only in effect for TIFs that were approved prior to 2023, for them to approve TIFs going forward, it's a very difficult thing to estimate how much increment that a local government could generate from the state TIF in this environment of lowering tax rates, and also makes it difficult for them to offer some of that to the private developers who are coming in and that they're wanting to incentivize to bring this economic development and pass that increment on to them. So those are the reasons that we needed the legislation, and that we believe in the state, in the interest of fairness and in the partnership between our local and state governments, that this is something that should be continued. I would open the floor for questions at this point.
Thanks, Brett. I sincerely appreciate it. Now, one thing about the moving forward items, though, is you don't necessarily have to base TIF financing on the income. Although it's been there, there are other taxing sources that could be based off of, correct?
That's correct. The mixed use and signature TIFs also participate the state property tax. That's not typically, at 11.4 cents per hundred. That doesn't generate a lot, but every little bit helps. In many state TIFs, the sales tax is almost is an equivalent driver as the income tax, and in some it actually generates more than the income tax. So those two taxes in particular would still be there. Technically, the corporate income tax is still available in the statute, but it becomes a difficult thing, I believe, and I would turn around to my folks here from the Department of Revenue. It's a difficult thing to calculate and allocate exactly how much of that typically is attributable to what's going on within the footprint at a corporate level. And so KEDFA has been, I would just say, generally not being wanting to put in that want revenue being put in that position, and they have not approved many TIFs in recent years with the corporate income tax rate as one of the participating taxes. Matter of fact, it may have been over 10 years since they've done that.
Very good. Thank you. Representative Petrie.
Thank you, Chairman McDaniel. There's a few of us in this room have talked about this issue in great detail, and you've come and spoken to me and helped me understand where you're coming from. And I understand the case that you're stating. I just want to make sure we put it in a context or sets of context with which I'm aware. I came in campaigning in 16 as others did, wanting to reduce the individual income tax rate, and in 18 that went from an effective 6, a funky 6, an effective 6 down to 5.
Yes.
The TIF issue was really not raised, as I understand it, from others as well as myself, and if it was, great, but as far as I know, it really wasn't. In 22, we have a formula that passes through the General Assembly that says, okay, we're not just doing a percentage, we're putting a formula in place. And at the very end of session, this issue was raised, and that's fine. But I want to make sure we understand the dates that are involved. Now, there have been good advocates on the issue of not sure how this is going to work and what remedy needs to be applied, if any, and so we've come up with 2 short-term solutions, and I'm happy to know that we're working further on it to get a more permanent addressing so everybody knows the ground is firm as they make decisions moving forward. But just because we've adopted 2 temporary addressments doesn't mean that the next one needs to be the same. For instance, if a TIF was created after 18, it raises a real question to me of whether someone was reading the weather patterns accurately. If it was in 2021, 22, and they created a TIF that is dependent upon the IIT rate, it really raises questions. And when we talk about addressments, we're not really talking about changing the TIF. The TIFs are about contract. And the contracts say not 5%, not 6%, not 4%, not 4.5%. It's actually a floating rate in the contracts of the TIF. So everyone with their eyes wide open signed off on contractual obligations, especially those after 18 in that first reduction. Now, I want to make sure, I'm glad that screen's up right there, to fully mitigate the impacts. What we're looking at is certain districts, areas across the state, and I think there's over 20 TIFs. I know you looked or sampled 10. I think there's well over 20. Yeah. We can see where those are geographically. We can see what the purposes were per TIF. But what we're essentially doing is saying you entered into a contractual agreement that had a floating term, and now there's a negative impact by a factor that was known to be moving at least since 18 officially, and we need to fully mitigate that. Fully mitigate means, okay, we need to tap every taxpayer in Kentucky and make sure that the contractual obligation is held harmless for all those that didn't look at the floating rate as a floating rate. Now, does that mean that we've got bad actors? Nope. Does that mean that everybody's at fault? Probably everybody's at fault and nobody's at fault. It's a situation to be addressed, but I want to make sure we've got the context of some timing, and that when we're talking about mitigating and addressing, it's not a failure of the formula, and it's not a failure of reform to IIT. It goes further back to contractual obligations that had a floating rate. So we need to take that into account when we're looking at it. Am I open? So don't take my comments, I'm vehemently and adamantly opposed, because I am not. But I think we need to be careful and look at all the factors as we try to come to a firm, more permanent addressing of the issue, which I think is appropriate. Thank you, Mr. Chairman.
Yeah,
Thank you.
Could I maybe just address
Yeah.
that a little bit? One thing, we've talked about this before, Representative. Back when we went from the bracketed 6% rate to the 5% flat rate, there were less than half of the TIFs at that point that we have now. The growth in that has come about, and so it's become a wider spread issue and so forth. So that is the main reason why it was, I think, elevated this time as opposed to before, where maybe not, there probably wasn't as much understanding of where, even though we had a 6% capped rate, that really wasn't the effective rate because of the brackets, how much impact that was going to have on some of these. I think that's why it didn't get elevated to the level of the General Assembly before. But I will say this, and I mentioned it just then, is there has been debt incurred by some party or parties in all of these projects. And whether that is the local government doing that as part to build something like a parking garage that's public, or whether through a master development agreement you have the private sector incurring all the cost and incurring some portion of that themselves. Without some stability in the in the way that we estimate what that can generate, it's very difficult to find a private partner to come along and take the risk when we say, well, the rate's this today, but we can estimate it at that, but it may actually go down, and we don't know when it's going down. And that makes it very difficult on the local governments to actually bring in, and which is part of the mission of the TIF program, is to bring in the private investment and pay for some of these things that otherwise would be on the public sector. It really makes it hard to have those negotiations with those private parties if there's just uncertainty with that tax.
Well, but you just would have to discount the involvement of the tax in the overall capital stack moving forward, right?
I'm sorry?
You just have to discount the importance of the income tax in the overall capital stack for forward-looking projects, correct?
You could.
The real issue is the rearview mirror projects.
Yes, you could, but that's a good point. But the majority of these projects that you see coming along are typically mixed use. So there is a mixture of things, whether it be office space or a hotel or residential and so forth, that the individual income tax is always a component of it. So if you discount it to zero and say, well, we don't know what it can generate, but anything you do get is gravy, that still, I think, potentially pulls the rug out of some projects that otherwise would be able to go forward.
Got it. All right, thank you. Senator Givens.
Mr. Chairman, I'm not a CPA, but I feel like I deserve continuing ed credits in some form or fashion for the presentations
Staff will be
today
issuing
after lunch.
certificates
So
after
if
this.
staff could generate even some fake certificates, would feel really validating for what we've gone through. Great conversation on the TIF question. You mentioned 10 TIF districts. Chairman Petrie indicated 20, somewhere in that range. Yeah. Approximately how many of those do rely on some or rely heavily on the IIT? Do we know how many?
Of the 10,
Of the 10 or of the 20?
probably about half of the 10. The 10 I have access to our clients. I don't have access to the information for the others that aren't our clients. So
Okay.
I can't address that.
So not all, but some do rely on the individual income tax.
Right.
Now, the other question that I had, and it's interesting to me as we've traveled this path, we hear a lot of reference to debt being incurred and the impact that has. Do we have access in the process of incurring debt? I would presume that local entity has some expectation of performance of the TIF if they're going to use those funds to defray the cost of the debt. Am I correct in assuming that?
Absolutely.
Okay. Do we have access to performance as it relates to expectations? And are some of these TIFs overperforming, underperforming, or do you know?
I would say the answer is yes. I don't have that information in front of me, but to the extent that ones I do have, I'd be glad to provide it.
If staff could, because I know in the midst of the conversations last year, we tried to get access to information, and I don't feel like staff, our talented staff, is very able to ask questions and very able to receive responses. I don't think we got the responses we were wanting, despite multiple efforts to get that information. I don't think that's your fault because you're not the person that should be providing it. But if we can find a way, if the two chairmen would so indulge writing a letter, addressing it to whoever it needs to be addressed to, it would be interesting to know the number of TIFs that are overperforming and underperforming as we make these decisions going forward.
We'll be certain that the letter is attached to your certificate from today.
Thank you.
Senator Boswell.
Thank you, Mr. Chairman. Well, I'm sorry. Yes, Senator Givens and Senator McDaniel filed a bill in the last session, Senate Bill 129, which I was the co-sponsor of because of one of the TIFs in my district, which is an older TIF. But I think that, to me, what this all boils down to when you finally get it all settled in is that promises that were made should be kept, whatever we do.
That's certainly the view of our client, yes, and us.
All right, very well. Any others? All right. Well, thank you very much for being here today. We sincerely appreciate it. At this time, I'm going to entertain a motion on approval from the minutes from last month's meeting by Co-Chair Petrie, second by Representative Bray. All those in favor signify by saying aye.
Question before we vote.
Representative.
On last month's minutes, there was a conversation about USA Cares appropriation.
Yes.
And has that been resolved? Have there been matters taken place that has cleared that up?
I'm getting some head nods up and down here, so I'm assuming the answer is
Can
yes.
we include that as an addendum to the minutes as to what that clarification is?
I don't think that we could because those are minutes that actually record that, but I will ask that note be made in this month's minutes, since it was addressed in this meeting, that we believe it to be resolved.
Okay.
Yeah, and Co-Chair Petrie said we'll revisit it next month if for some reason it's not.
So we could put that in the minutes and discuss it at the next meeting.
That's
Okay. All right. Thank you, Mr. Chairman.
yes, sir, very well. Okay. All those in favor signify by saying aye. Aye. Opposed, like sign. Ayes have it. Meeting minutes are adopted. Okay. In the electronic package you guys have all been provided, there is correspondence from Jenny Bannister as well as from Jennifer Hayes. So please make sure to take a look at that. Our next meeting is August 21st, 1 p.m. here in this room, and will be chaired by Co-Chair Petrie. Seeing no other business come from the committee, we'll stand adjourned.